All right, guys. Well, happy Monday. Let's get this show on the road. So we've got a couple things to talk about today, and I'm going to share my screen, and I just want everyone to kind of read along, and I'll kind of give you some highlights. So this service that a lot of us use called MBS Highway is just something that's very valuable and trusted, and
Trusted
um,
and
it's
um,
it's what we use to track the bond market, which we're going to pull up here in a second. But we get a daily update, and if you guys saw like anything that some of us might have posted or text you this morning, um, we're going to talk about the Fed a little bit, and we have a Fed chair that's new, Chair Warsh. The first Fed meeting was last week, and what Fed Chair Warsh said gives us an indication of what a new Fed chair and kind of new leadership, how they might view the markets. So, um, and along that line, so if you guys remember the most famous chair, Fed chair that most of us have heard of, Alan Greenspan passed away recently. I think either today or over the weekend. Um, and the current Fed chair learned a lot from Greenspan, who, by many people's estimates, was one of the most well-known and maybe most successful Fed chairs in history. And the difference between Chair Warsh, so Kevin Warsh, the new Fed chair, and the previous Fed chair is he's looking at different things to measure the economy, different measures of inflation. He created five task forces to look at other ways to measure how Fed policy should be implemented. And in the late 90s, and if you guys look at this paragraph here, September 1996, so inflation was rising and there was a lot of pressure on Fed Chair Greenspan, who was Fed Chair back then, to hike rates. And one of the people that was putting the pressure on him was Janet Yellen, who herself was Fed Chair here recently before Jerome Powell. And he did not hike rates at the time. And he didn't hike rates because he saw the future of
recording
the
in
internet
progress.
and how the internet would increase productivity, and that would bring the cost of goods and services, the cost of labor down. And he was right. And most people were saying in the face of rising inflation, hike. He didn't. He made the right call. And a lot of people are comparing that to today with another technological revolution, which is AI. And in the face of rising inflation, um, does the Fed need to start hiking rates sooner than later, or should they let the market play a little bit and see if AI brings the cost of goods and services and wage-based inflation down, which it very well could. Just an interesting chart here. I'm going to leave this up while we're talking about a few other things. So last week we got a Fed meeting. We don't have a jobs report for a few weeks. The next big measure that the market's going to watch is this Thursday, and it's historically the Fed's favorite measure of inflation, which is the PCE, or the personal consumption expenditure. That's going to be a big one, and here's why. And I've been showing this Fed CME kind of prediction tool for the last couple of weeks. Um, the current Fed funds rate target is 3.5 to 3.75. And expectations of those polled, so 36% in real time are expecting a Fed rate hike at the next meeting. And if you remember the last few weeks when we've shown this, those numbers have been all over the place, but expectations are trending that we might see a Fed rate hike sooner than later. If you guys were with us last week and the week before, I said that a Fed rate hike, and this is a little bit counterintuitive, would actually probably bring mortgage rates down. Okay. Why is that? What's the one factor that influences mortgage rates more than anything else? It's inflation, rising mortgage rates, lower inflation, lower mortgage rates. If the Fed hikes in July, so the next meeting is July 29th, so we're 5 weeks from Wednesday, what will that do to signal the market? That'll signal to the market that Fed Chair Warsh is an inflation hawk, or he's willing to fight inflation. And if he's willing to fight inflation, the bond market, the long bond market, will actually like it. And so there's a decent chance that a Fed rate hike in July could send a signal to the markets that he's willing to fight inflation, keep it down, and mortgage rates could possibly improve. So different directions, one moving up, one moving down. That's not a trend that you're going to see consistently forever. Historically speaking, if the Fed is hiking rates, mortgage rates are going up. If the Fed's cutting, mortgage rates are going down. But in the short term, they can move in opposite directions. The last time we saw that happen, and I'll pull the chart up here, um, the end of 2024, and if you remember this, and we've talked about it a lot on our calls here, the Fed cut the Fed funds rate at the end of 2024. So the Fed cut here, and at the same time, the bond market sold off like this, and mortgage rates went up. So the Fed cut the Fed funds rate a point. Mortgage rates went up from 6% to 7% within 60 days. The opposite could happen. Now, we're not calling for rates to go down a point, but a Fed rate hike wouldn't necessarily be bad news for mortgage rates. And if we go back to the Fed CME tool, you're seeing 36% expected Fed rate hike by September. And then, I'm sorry, by July. And then by September, you're at 72% think we're going to have one, or some people think even two rate hikes by then. Now, Barry Habib, who most of us follow, who owns this service, this MBS Highway, where we get our charts and graphs, he thinks that Chair Warsh is forming some of these task forces that are kind of new initiatives with the Fed to look at more data and make a better overall decision with more data on what they should do with interest rates. He thinks that they could use this as a reason to delay hikes, but to tell the market they're researching more and more data to make the appropriate decision. But anytime there's a major change, think of like a presidential administration, when office changes hands, and it's not really in January, but like in November, every 4 years, the market's very volatile when a new president wins office and is going to take office, and the market's trying to digest what is the market likely to do, what's the new administration going to do, and there's lots of volatility. You saw it when Trump won in 2017. You saw it when Biden won in 2025 or 2021, and you saw it when Trump won again in November of 2025. And so expect a lot of volatility for the next few weeks. I think it's important that when we're talking to customers, and it's great content, like we're going to do videos this week that says a Fed rate hike doesn't mean higher mortgage rates. Get that information out in front of your customers. I think it's a way to present to them that you're the expert that can be trusted. But that's great content for the next month or so. If we do get a Fed rate hike in July, it would be pretty awesome if all of our customers knew what that actually meant in the real world, that it doesn't necessarily mean higher mortgage rates if the Fed is hiking. Because what do most people think, and what does the media tell them, and what do all their friends and family tell them? If the Fed rate hikes July 29th, which they potentially could, everybody's going to be talking about mortgage rates going up. And the reality is they might actually be going down. Okay. What I wanted to talk about mostly today, and I would love the more interaction we can get with this. So most of us are in the Southeast, not all of us. And we were all in a very heavy multiple offer market during 2020, 21, and 22. The market has shifted the last couple of years, certainly probably more favorable to buyers. You're seeing less multiple offers than you have been. It feels like it's changing, and our team as a group is involved in 75 closings a month, more or less. So, how many offers are we seeing to get to 75 closings? And we've been talking about amongst ourselves for a few weeks that we're seeing more multiple offers. We're feeling that. And just personally over the weekend, had a couple clients out shopping at houses in various price points from 400,000 to a million that saw multiple offers. Oftentimes in the past few months, we would see a price, let's say listed for 500, that cut to 475, that cut to 450, and then 450 is the number. That's really what the market value was. And now a 60-day listing is flooded with activity and offers because it hit the right price. And it feels like we're seeing more and more multiple offers. And so I think it's appropriate for us to talk today about what are some tactics and strategies to win in multiple offer situations. Certainly price is probably the most important factor. But outside of price, what are things we can do with contract terms or tactically to help be competitive in a multiple offer situation? So I want to talk about that. And then also, I think messaging to customers. I was talking to Barb Mills, and I don't know if Barb is on this morning, but I know Sherry is. And we were talking about a client that we have that's making an offer today. And of course, the listing agent's like, hey, I got another one coming in. And so, how do we communicate to our customers to make them feel like they're getting a good deal, but win when there's multiple offers and it's competitive? And so, I feel like most buyers are expecting to pay below listing price, um, which I would say broad brush as a whole, if you look at the overall market, that is probably accurate, right? Most people are offering and getting offers accepted below listing price. The percentage or the degree to which they get below listing price certainly can vary. But I think messaging for all of us to start talking to customers about is listing price and market value are not one and the same. For the past 24 months or so, most buyers are expecting to offer below list, and they were probably negotiating and getting below list. List it for 475, they offer 445, they land at 460, they feel like they got a good deal, right? Well, it seems like more sellers are listing or listening to the realtors and listing for 460 out the gate versus 475, knowing price reductions are coming. And so that same house that was listed for 460 may sell for 460, and the buyer still may be getting a good deal. Um, One of the things that we look at oftentimes when we're talking to customers, and we try to do this when we're doing consults with buyers, like before they've been actually looking, um, looking to and showing them how you can figure out what a seller paid for the house and when they purchased it. So a seller listed for 475 that bought it for 300,000 in 2020, is that person necessarily motivated to do a massive price reduction? Are they a distressed, um, under pressure seller? Probably not, right? Probably not. They're sitting on a lot of equity. Last week, we used the statistic that nationwide, the average loan to value of all owners across the country was like 28%, meaning that there's $14 trillion of mortgage debt in residential single family housing across the country is worth like 49 trillion. And so the average person is like 70% equity in their house. Is the average person a distressed seller? Certainly not, if they're sitting on average 70% equity. Um, and so messaging that to customers that you can get a good deal, but still pay close to the listing price, might be appropriate. So, but let's talk about tactics for multiple offers. And so, and if any of you guys want to jump in, Abby, I saw your comment. Feel free to pop in. I'll share a couple so um, that we can control. So let's talk about appraisals. Okay. So for most buyers, do you need to have a written separate from financing appraisal contingency? And this varies a little bit state to state. But generally speaking, you really don't need a separate appraisal contingency. You just need a financing contingency. Um, and I'll use the qualifier if the person is not making a massive down payment. Okay, so when might you want an appraisal contingency? If a person's paying 400,000 and they're planning on putting down 200,000, that appraisal could come in at 225 and we could still do the person's loan.
I'm glad you're
Meaning that,
bringing this up. I have a question because I do wonder about this sometimes. Do I put one in if if they have the built-in finance contingency, are they still protected
yeah,
in terms of if they have the money, do they still need to perform on the contract? Or do you have to send us a letter saying they cannot qualify because they don't have the money? Like
yeah.
were they fully protected in the finance contingency?
So let's say I'm paying 400,000, I'm putting down 5%, okay? And the contract says 5% down. If that appraisal comes in $5,000 low, and now I'm at a 97% loan to value, um, I could issue a loan denial letter because of collateral and with a low appraisal. So in that case, I feel like the financing contingency kind of wraps in the appraisal all in one. If that person was paying 400,000 and financing two, and the appraisal came in low, it could come in at 250,000, and we're still technically an 80% loan to value loan. And lenders, we really can't write a denial letter if we can still do the loan. And technically, we could still do the loan for that person on a 400 price, 250 appraisal, 200 loan. It's still an 80% loan to value. Now, are there other ways that we could get creative and figure out how to deny someone and not like cross an ethical gray area? In many cases, probably so. Um, but I think if you're concerned about value and you're putting a lot of money down, then that may be the person that if you don't want to put it in the contract, do your appraisal quickly and try to knock it out during the inspection period. Um, but generally speaking, for the most part, for most closings, you probably don't need a separate written appraisal contingency because the financing will protect you. Again, most, not all cases, but most. Um, how about financing contingency? So, and again, different states have different language. Like in Florida, the word loan commitment does not exist in the contract. It's loan approval. So a lot of people still use like old terminology. Um, but there's default dates for loan approval. So, and Aaron put this in the chat, like how can you um, be able to shorten your loan approval period of time? Well, like we do fast track approvals, which is when we send someone to underwriting, we get a full loan commitment while they're out house shopping and they are literally approved in underwriting. Their income, assets, and credit have been fully verified before they find a house. That's a way to shorten the financing contingency. Um, Fast closings, larger escrow deposits. But I think the contingencies I feel like is where you can get competitive, like short contingencies, faster closings. And for us, like if we do a fast track for someone and they're fully approved in underwriting before they make an offer, then that's certainly um, a contract that we can also perform on. Um, and I feel like that's a conversation that we as lenders and probably all of us lenders and realtors as like a tag team effort, we should start having that conversation more often with people of what like I was talking to a person the other day and they had a realtor and I was like, hey, has your realtor talked to you about the market? And they hadn't done a consult with their realtor yet because the realtor was like, hey, talk to Mike first, get qualified, and then you and I will do a consult. And so like I do my consult, she does hers, and we both kind of talk about the market. And so I was like, well, hey, real quick, I gave them like a high level, here's what we're seeing, here's what's happening with inventory, here's what's happening with multiple offers. But I think that formal consult step that sometimes we all skip, like, a client walks in an open house and wants to make an offer, you're kind of rushing to offer stage and, you're skipping some of the consultation piece of it. Sometimes there's not time, like I pre-approved someone on Saturday afternoon that made an offer like Saturday night. Um,
That's what
but
happened to us the weekends, which was very rushed.
yep.
But I do recommend, guys, real quick, to call your lender, right? So if you know, like, and calling the listing agent too is kind of how me and Mike handled it a couple weekends ago.
Hmm.
Same situation. It was a Saturday night. Saturday actually was Memorial Day weekend. So that was great, doing all the things, trying to manage. But I think, calling the listing agent, there's multiple offers, right? Okay, so they don't want to overpay their first time, semi first time home buyers. So they're not totally experienced with how this all works. And when I called Mike and told him what the listing agent talked to me about, because you always, again, talk to the listing agent and say, can you give me some kind of tips on how to win this? And some agents will. Some agents will not give you enough information. In this instance, she did. We did have to come up another 10,000 after the fact. That was my suggestion. That was my recommendation. And we ended up winning it at 9 o'clock at night. And it was great. Everybody was happy. But it was also one of those situations where I think it's important too, to, like Mike said, see what they paid for it. This woman had purchased the property only a year ago. So there was not a lot of equity position for her in terms of what she was going to walk away with. But it was a situation where when you look at the comps, they've dropped it below market, right? So there's a difference, like you said, between what is the market value and, what's the equity position. So where they were, we knew if we came up, where we were, we would still be okay in terms of they didn't overpay. In fact, they walked in with what, 35,000 in equity, Mike? Because the
Yeah,
appraisal
it came in high.
came,
Yeah.
right. So the appraisal came in high to where I think, yeah, so it was under contract for 610, came in at 645 for the appraisal. So it was a great situation for the buyers. It was very rushed because it was a quick, I need a lender right now. I need a lender that's going to get it done right now. And, cross country, like, always kudos to you guys because I haven't done a deal with Mike. Actually, this is our first deal. I've known him for a long time, but I've been engaged in everything that he's been doing, like his teachings and all the things and this stuff. Like, it was just something I was like, I know I can call Mike and he's going to get it done. And we got it done. So I think it's just like that, the whole situation with looking at all the aspects and coming up with an idea and a solution together, and that's what we did.
That was a seller that we knew needed a certain number, so we would come up in price,
Right.
but I think we won too because it was a fast close. It's been
Yeah.
like less
Yep.
than 2 weeks. So,
Yep.
um, but the other thing you guys can do as well, in addition to looking to see what the seller paid for it, and different counties are different, and some are easy and some are hard to get public records. But like in Orange County, where my office is, it's really easy to look up in public records and figure out. Like any of you guys on the call today that live in Orange County, like I could tell you where you live, what you paid for your house, and what the mortgage balance was. Now, I can't tell you what you owe today, but I could look up and figure out what mortgage balance that you took out when you purchased the property or refinanced it. And again, different counties, some are easier, some are harder. But if you're familiar with your county appraiser's website, or like, you can go to like the courthouse and search online. That's some good intel to get as well. So like if this person paid 500 a year ago, but financed 300, are they really a distressed seller, or are they just looking to get a number and not feel like crap because they're losing money on a house? It's a little bit different. And Sherry Brandy Realist, that's good info. I'm not sure what that is, but that's probably a realtor tool, but that's good intel. Um, um, Nicole, you had a question. How long for loan approval if they're fast track? So if you want to wrap loan approval, inspection, appraisal all into one, I think you can get it all done in 10 days. Um, and you can do loan approval faster than that if we're fast tracked, but do you have enough time for the appraisal? Um, another tactic that I think is beneficial, and this is something that our whole team practices, when we get a contract, so a contract comes in today's, and we're sending loan disclosures out, we always order the appraisal the same day. Now, some of you guys might say, well, hold on a second. I don't want to order the appraisal until the inspection's clean. The way our appraisal system works is when we order it, it just goes in the queue as an order. Nothing processes until the buyer pays for it. But by getting it in the queue, we've saved ourselves like 24 hours. So let's say let's say you had multiple offers over the weekend, okay? And we said 10-day financing next Wednesday, and we're going to do everything within that time period. Appraisals take about a week, and it's hard to rush appraisers right now. They are really, really busy, like everybody is. Even paying them, we'll give you $100 or $200 more. It's hard to get like rush appraisals done. Different in some markets, but in general, it's not easy. They're really, really busy. So how can we, let's say, go to contract today and have a financing contingency next Wednesday, July 1st, if we don't want to do the appraisal until the inspection's done, right? Well, one is we order the appraisal today, it's in the queue. The buyer knows to pay for it once the inspection's clear. As soon as they pay for it, they're reaching out to the realtors to get into the property. So that's a way to save 24 hours on the front end. So you guys are probably all used to like the automated emails and texts that cross country sends you, and you probably get emails and texts, the appraisal was ordered, and you might be like, hold on a second, the inspection's not for 4 days. Don't stress, that's normal. That just means it's in the queue. We've all coached the buyers, pay for the appraisal when the inspection's clear, but what if the inspection's not going to be done until Thursday? Can I wait till Thursday night or Friday to pay for the appraisal post inspection and have the appraisal back by next Wednesday? Probably not. So then here's what you do in that situation. You have the buyer pay for the appraisal on Wednesday with the inspection being done Thursday. We know they're not calling the listing agent or pulling showing instructions till Thursday. And we get automated emails that tell us when it's scheduled for. And as long as it's scheduled for Friday or Saturday after the inspection, we're not in danger of them spending money on the appraisal if the inspection is a disaster. So let's say we order the appraisal today. The buyer pays for it on Wednesday. On Thursday, we have inspection being done and the listing agent's getting called. And let's say they schedule the appraisal for Friday. If Thursday at 5, um, Dave calls me up and says, "Hey, Mike, this appraisal inspection was bad. We're negotiating. Let's put a hold on the appraisal." And then we literally log into the system and tell the appraiser, put it on hold. They cancel the appointment, and the buyer's money is not, it's been charged, but it's still refundable because the appraiser hasn't gone to the property yet. And so that's a way to squeeze a little bit more time where you can save a day or two on the front end as well. So there's a lot of things you can do on the appraisal to shorten the financing contingency. Um, a conversation of prepping buyers, things like, you're going to have to write a deposit. You're going to have to send it via wire. When you do your deposit, that has to happen quickly. Here's the inspectors I use. As soon as our contract's accepted, let's get them scheduled and let's get them out to the property within 48 hours. So there's things you can do to save yourself some time on the front end that lets you write contracts that have either a shorter closing period or a shorter contingency period. Um, we found that a lot of buyers get nervous doing shorter contingency periods or shorter closing periods. It's not what they want, but sometimes it's what's required to win. And so we usually have the conversation with people and we'll say there's typically three, but sometimes two contingencies where you can get your deposit back. One is the inspection, two is the financing. And if we had that conversation during like the consult phase, like as they're gathering documents, they're approved, they're out getting ready to make offers. Then when we get to the point where they found a house they like and we know it's competitive because it's either new in the market or they just did a price reduction or we know there is a lot of activity, we can say like, and when I say we, this is like loan officer, realtor, like as team effort, right? Like we're both telling them the same things. We can say, hey, do you remember when we talked about the shortening the contingencies to win in a competitive situation? We're in that now, so that's what we're going to do. And it's much easier for a buyer to say, yep, I'm on board. I remember we talked about it. I understand the strategy. If we educate them on that process during consultations before they're making offers when they're not stressed, then when they are stressed, it's easier for them to make a clear decision. And I know there's been people that like I personally have not had that conversation. They're ready to make an offer. And I start throwing all right, we got to go fast. We got to go quick. We got to make an offer. We got to, escrow and we got to do a short contingency and we're going to close in 10 days. And they're like, whoa, hold on a second, buddy. I'm freaking out. We're just going to, pump the brakes a little bit here. Um, and so that's a conversation that I think it's good for all of us to have. And I think like, so Abby talked earlier, like me and Abby should have the conversations and share intel like, hey, I talked to him about this. And she's like, cool, I talked to him about that. And that way we know that we've all had those conversations with them of how to win in multiple offer situations. And we're spending a lot of time on it today because just amongst our team, as we've been talking the past couple of weeks, we're seeing a lot of it. And it's not necessarily a price point thing or a market specific thing. It just seems like a trend. And it makes sense. It's the summer. We're in kind of the busier season of the year. Um, it feels like the summer busy season started a little bit later this year than normal. But if we're seeing it in certain markets and certain price points, we're probably seeing it everywhere. So um, just wanted to bring that up today. That tactically, I think that how to win in that situation. And the last thing I'll leave you guys with is um, we love talking to listing agents. Every loan officer on our team, like we would actually prefer to talk to listing agents and help you guys sell the buyers. So whether that's you tell the listing agent, hey, here's Brent's phone number. Call Brent, if you have questions. Or it's like, hey, call this realtor. Here's the listing agent's name and phone number. We'll do whatever you guys want. Um, Most realtors that we work with copy us when they make an offer. So for example, like I'm working with a realtor, like they may copy me on the offer, like, hey, dear listing agent, here's my offer, here's a little bit about the buyer, copy my lender, a little bit about the lender. And then we all have email signatures where we just hit reply, insert signature, and it's something along the lines of like, hi, listing agent, look forward to working with you. My cell is like, we make it like a big deal. Like, my cell is blah, blah, blah. Call me anytime. Let me know if there's any questions you have about the buyer, right? And just those little touch points, like that show we're all on the ball working quickly, I think can give the listing agent some comfort that they're working with a team, buyer's agent, buyer, lender that are on it, that are going to perform. Um, but I think, like I talked to a listing agent on Friday and we didn't win because it was multiple offers and not really sure what exactly happened. And if someone just went way over listing price, it was like $1 million house that had been in the market for 30 days. So none of these tactics are guaranteed of success, but the more of these that we use, we increase the likelihood that we're going to be successful. So appreciate you guys letting us spend some time on that today. If you guys want to talk more tactics on multiple offers, let us know. We can talk more about this next week, or just call whoever you work with on our team directly and let's chat about strategies. And it'll be different for each buyer and each market and each price point, but it's definitely a trend that we're seeing more and more of. And I think everybody here on the call is kind of agreed that we're all seeing more of it. So um, with that, guys, have a great day. Have a great week. We will see you guys next Monday. The big PCE report Thursday morning at 8:30. Fox Business or CNBC will have live info that'll be good intel for you to share. And we'll see you guys next Monday. Thanks, everybody.